One of the motivations and relevance to this conversation and our audience is that you said the L word. We call it the L word. It's called liquidity, right? Exits need to be engineered. But at the end of the day, this technology will be an on-ramp that enables us to make it easier to deliver liquidity in current illiquid assets.
Hello and welcome to Rule of 40, the show all about Australia's tech scale-ups, the founders, operators and investors building global companies from right here at home. I'm Josh Askoff and with me as always is Jason Serta.
Hello, hello.
Today we're talking about something that's gone from grey zone, maybe one day, to something that is an actual green light in a very short space of time. The tokenisation of real financial assets here in Australia and what it means for you when you're running a fund, holding liquid assets or building in financial tech. To help make sense of this, we've got someone we know very well and who we're very proud to call a friend of Utiliti in Alan Burt. Welcome, Alan.
Welcome, welcome.
Thanks, guys. Great to be here.
Alan's the executive chairman of Redbelly Networks, co-founder and general partner of Beachhead Ventures Capital. Alan is also a co-investor with Utiliti in a number of great businesses and someone that Jason and I really enjoy talking to about all things investment and innovation.
He tells me when some of the investments are crazy. Right.
And that doesn't stop anything.
Alan, welcome to Rule of 40. And before we get into the detail, tell us one thing that the listeners should know about you.
Well, other than being a venture tragic, I have just begun. If venture investing wasn't a good way to lose money, making wine is a better way to lose money.
Making wine.
So I've just started, while the rest of the world is getting out of alcohol consumption, I'm going all in.
That's because you're drinking it all?
I am drinking the profits. It is a hazard. But yeah, no, it's our first vintage. So we're just, that's going to be exciting.
That's amazing.
So Alan, let's start. You've worn a lot of hats. You've been a venture investor. You've done a lot in the Redbelly space, across crypto. How did you end up where you are today?
So I'm actually a technologist like Jason. Actually, funny fact, Jason tried to buy my business back in the day.
Oh, that's right. We did. That's going back a bit.
Usually, as usual, he likes to lowball offers. So watch out, founders.
I was much better looking back then.
Not true. So we I've got an IT services background and made my original exit, and so an entrepreneur, never had a real job, if you will. Built my own cloud services business, early stages of that, and then exited that back in 2013, and then beyond that, became an early stage and entrepreneurial kind of tragic and started kind of co-investing with a couple of other guys that I knew, which became Beachhead Venture Capital. And then along the way, fell in love with a variety of different startups and founders and particularly the thematic I'm in heavily now, which is the blockchain tokenization one. But obviously B2B SaaS was a thing, but love technology, always have, think it's magic. And what it can do for the world never ceases to surprise me. So I love getting involved at any stage of that.
One of the businesses that you do see ones that you don't actually do, right? Like it's the one that got away. He smiles.
And so, Alan, for a listener who hears blockchain or tokenization and don't quite know what that means, what is it and why does it matter?
So tokenization often confused with crypto, and because crypto uses tokenization, I guess the difference is why we're now kind of reframing crypto into tokenization is it's about what the underlying asset is. So in crypto, you can tokenize a cat picture, you can tokenize a Trump coin, you can, and so what the underlying value is and the network effects, and there's kind of an neat intersection in crypto between social and investing / gambling, however we want to look at that. But what tokenization is focused on now is how do we use that same technology, that same shared ledger to program assets. So instead of an asset being a set of rules on a piece of paper that people enforce, we can now program those assets into a shared ledger that we don't have to trust somebody to execute. So at the moment, we rely on accountants, trustees, custodians, a bunch of other people in finance to enforce our rights and to play independent parties. Well, we're now in a position where we can use technology as that trusted basis, and we do that by distributing the computing power and then coming to agreement on a particular state at a time, and then executing rules and agreeing how those rules will get executed. And so by having this, digital commons where we can now trade this, the art of or the act of creating a token, which is we usually refer to it as a smart contract. So it's a set of rules that the underlying computing stack executes against, that's what we call tokenisation. So it's programming the rules, the obligations, and who owns what, and the ability to fractionalise that into the tiniest little slices. So there's a bunch of things wrapped into what that looks like. But from a utility perspective, we can trade that globally 24/7 against a shared ledger. And that's what really is unlocking these opportunities, and particularly financial services, which is the part that I'm most invested in.
This is about the future of how financial services are going to operate.
Absolutely, it is.
Right?
Yep.
And some of the new laws that have just been passed by the Australian government, sometimes they do good things. It's very topical at the moment, but this is a good thing.
This one got overshadowed, but yes, this was a very good thing. Back in the 8th of April, the Houses of Parliament passed the digital assets laws, and through that there kind of became two good things that happened. One, we got regulatory clarity around, call them crypto platforms or digital asset platforms, and they're now regulated financial services, so we can all now trust that there's accountability for who's doing what in that, and putting some formal structure around it. There's also a new category around how custody works. So a lot of the big, here I am telling you this is a trustless technology, yet most of the trading in these things happens in off-chain black boxes. So I send my tokens to you and trust you that you're going to give them back, kind of anti-blockchain, if you like. And so there's now rules around what you can do with my tokens and who has to hold them and the separation. So bringing normal financial services structure and regulation to those. So that's been really good to give the whole sector confidence. But most importantly, which is the one I'm really excited about, is this new classification in the Corps Act of a digital public token infrastructure, aka a blockchain, that defines now legally that a blockchain is infrastructure and isn't a financial service product. And so that now gives us all clarity that if we are transacting in a particular way, that is infrastructure, not a financial service and product. And now we have all the licensing and clarity to really start doing these financial services in earnest.
And Redbelly then is therefore classified as one of those, is that
yeah,
right?
So Redbelly Network, which is, no doubt we'll talk about the project in more depth, its definition is to build a public digital token infrastructure, i.e. a public blockchain.
Let's not leave the people waiting. Let's talk about Redbelly Networks in that case. And you were part of Project Acacia.
Yeah.
What was the role, and now where does that leave the business going forward?
So talk about a slow burn. Unlike obviously, kind of market transformation is slow, but the Project Acacia is an initiative that was run by the Reserve Bank of Australia to evaluate the impact of tokenisation on the Australian economy. And what its role was in payments and settling trade. So in that, they did 20 plus use cases, of which 4 of them, most of them were run on Redbelly. Redbelly, interestingly, was the only place globally that any central bank has issued an obligation from the central bank onto a public blockchain. So there's been plenty of trials globally around closed and permission systems, but no one's taken the leap to putting central bank money on a public blockchain. So that was important for us. One, very helpful, the RBA took that progressive view, but moreover that the settings and how we've configured the network, as an example, our network requires identity. So unlike a lot of these permissionless anonymous networks that you hear about with some of the less reputable acts that happen in fraud, and like we require everyone to be identified on the network.
A lot more secure, right?
A lot more secure, and so we can then put not just they say code is law in the crypto space, but actually law is law. And what is neat is if you can rely on law and the tokenisation together, we think that is a big step forward in what we can do. And the RBA agreed in granting us to join that program, and we ran digital bonds. We ran secondary trades on funds, which would be interesting for you.
Yeah.
What else did we do? We did a securitization projects. This is how mortgages and credit enhancement gets done. So lots of different financial primitives and products, all tested around what the role of the central bank's money is in settling those, but also how a public blockchain could save or do things differently to the status quo.
And all the major banks participated as well, right?
All the major banks participated, yep. So they all did various POCs for themselves, different repo markets in the case of CBA, how they could be using their collateral in tokenised form to realise liquidity. We think one of the killer use cases. So yeah, that's been a big push. So we've had the laws come into effect. We've had the RBA signalling that we're keen to put Australia on the map. And there's about a bit of research that's demonstrated as a result of that $24 billion annually could be saved in financial services, i.e. a productivity gain of 1% of GDP. So on the productivity agenda of Australia, it's relevant.
Well, one of the motivations and relevance to this conversation and our audience is that you said the L word. We call it the L word. It's called liquidity, right? Exits need to be engineered. But at the end of the day, this technology will be an on-ramp that enables us to make it easier to deliver liquidity in current illiquid assets.
Absolutely.
Which you and I have a few.
That's true. There's other reasons for some of these things to be illiquid. I mean, funds I think are interesting, but the other thing is how we think about liquidity, right? So Elon and Jeff, they don't sell their stock. They realise their liquidity through borrowing and using collateral. So this technology will allow us to realise liquidity in all sorts of different ways, not just by how do I sell this thing that I want to change position, but how do I take leverage on this position, or how do I borrow? And that kind of creates a way more efficient capital market and allows us to allocate risk very differently, right? Like if you think about how we now kind of almost trade by appointment or go and raise a bunch of capital and deploy it over a timeline, this allows us to be way more capital mobile and take different positions. I've got to invest with you for a 5 to 7 year horizon. That's how much am I prepared to invest on that horizon is a different conversation to if you gave me the option of, and there's periodic liquidity, or you'll always have the option to trade that. The amount of capital you could raise would be quite different, let alone, now it's liquid, by the way, you could use it as collateral because there's a liquidity preference here. Off we go.
And we are absolutely determined in our up and coming new fund to be able to provide liquidity options. And I think our investor base has that expectation, right?
I think, Jay, as we went through this process of preparing for the new fund and going through those materials, we sat down and talked about, what did we want as investors, and, a 7 year horizon on a fund in Australia, I think, is still very ambitious. I think people are using all parts of their 10+2 of an ESBC LP at the moment, and there's no sign of that getting any better. So the timing of this change and the opportunity to look at things differently through a tokenisation lens is absolutely huge.
And this is true. If we think about OpenAI, Anthropic, or even locally Canva, these things that have done really well inside portfolios that you can't realise that gain. And moreover, some of these funds that are super desirable to get into that people can't, there is a real reason to.
We have collectively assets. I'm thinking of one particular asset that is worth at least 10 times, and we're 3 years into that investment. If our investors were given the option to be able to sell down a portion of their share and be able to do that, we would have people that'd be putting their hands up to do so.
Yep.
So I think it's just, the modernisation of the financial system needs to enable these things, and we need to lead the charge to try and drive those type of outcomes.
I think it's true, and I think these sorts of highly illiquid assets now, but that do have there's a couple of different problems when you're trying to make a liquid market, right? One of the big issues, particularly in the equity space that we play, is price discovery. Like, what's that asset worth? How do I deal with the valuation?
Yes.
Whereas when it's packaged into a fund, well, there's a person there that has to report what the NAV of the fund is. So you've got a better view as to what the underlying is, and also it's diversified a little bit. So starting with some of these sorts of assets are going to make a lot of sense. But that time horizon, to your point, I mean, and as you said, desirable for your investor in the first case, will help you attract more. Am I going to invest my money with a good track record, an investor that's going to lock me up for 5-7 years, or the optionality, even if I don't use it, the optionality is valuable. Probably less so in venture because you guys are just picking amazing winners. But if I'm thinking about private credit funds or some of the other funds where you're doing construction financing at 9-10%, I don't really care which one it is. The actual underlying credit risk or the manager is the risk. So I want to diversify that. And would I pick one that does have underlying liquidity or not when it's the same return and investment profile? That becomes we think about it as adding utility to the asset. Which is neat for your name, actually. But obviously adding liquidity and lending and borrowing, and the way this new legislation works, it allows the asset issuer inside their regulatory parameter to leverage this infrastructure to provide that utility to its investors.
A lot of this stuff is being done manually, right? Like, people transferring money, confirming assets. You've got a lot of people doing manual things, getting on the phone, validating. This is a lot more secure and a lot more accurate, and there's a lot of benefits all across the board.
Well, I think, like Alan, when you explain it the way you have in terms of what it creates and the way that it could enable the financial services industry down to venture, I think for founders out there that are finding the capital markets very different, because over the last couple of years, as the markets have begun to change, investors have moved their money into different assets in publicly listed stocks, things that have that shorter liquidity life cycle and allow you to deal with the changes at a macroeconomic level. So this change has a real potential to boost capital coming into a whole bunch of asset classes, including venture, which is needed to drive innovation and might counteract some of the other changes that are happening in this space.
Well, moreover, we need to get out of passive assets into productive assets, right? We need to be, hanging on to, controversially this week, hanging on to property as a passive asset versus, creating value with capital is an important thing for an economy. Just back to the VC thing for a second. I'm old enough, and I will admit that I lived the ICO boom, which was the initial coin offering boom of early crypto. So if you think about early crypto, that was actually democratizing the venture business. That was how do I invest in an early stage idea or company at a valuation. The only difference really was I had instant liquidity because I immediately put the money in. I was immediately issued a tradable token. So that's actually where I first went, what does this mean for venture? Now, what we really realize is we need people that actually know what they're doing to influence, pick winners and support those things to an outcome. But certainly it demonstrated how easy you could effectively crowdsource the right level of capital. You don't need to put $1 million check into a thing. You can put a $50 check into a thing. And so I think how we think about how risk is shared and distributed, and this is before we layer on an AI layer of how do we now discover assets? How do we discover investment opportunities? How do we now structure those? How do we place a lot of small bets and with liquidity as a profile? This totally changes self-directed investing, if you like, as to how we do all those things and allocate across all those other classes, hopefully to a more productive outcome.
I mean, look, we're going from locking up stuff for 7 to 10 years with no exit opportunity, no exit. You have distributed via manual wiring and email confirmations. You got no secondary market. Wait for a private buyer on occasion at a discount, and then cap table managed by spreadsheets and paper documents. And we're moving.
And that's never gone wrong.
Yeah, right. And we're moving to, token in digital wallets, visible and auditable, distribution automated by smart contracts, no emails, no lag, secondary transfers that are possible, programmatic with GP consent, right? And portfolio reporting in real time on chain, right?
Let me give you a macro here, right? So
come on.
$25 trillion worth of assets are available today to be used as collateral out of 235 trillion. So call it, my math isn't that good, circa 10%, let's call it, of assets are not available to unlock leverage or collateral. So by using them by tokenizing these things and having the ability for these other markets to form and support them, we unlock a bunch more capital for all these users and the opportunity to make more return from our assets that might be locked into one position today.
And you can lend against them, and that's how you get liquidity options. Come on, we can do some
collateral
smart
mobility.
Things, people.
Absolutely.
Come on.
Well, the big one that we talk about in real world assets at the moment is what we call the looping trade. And so this is where I buy an asset, borrow an asset, use the borrowing to buy the asset again, and just lever it up. But it doesn't actually change the underlying profile, the risk profile, right? Because you've got, if we're using something that's paying let's say it's a private credit fund paying 10 or 12%, and your borrowing costs are less than that, you've got a carry trade in the middle, and you can lever that up to take yield enhance that to 20%.
I feel like I've done my job. I always say that, we try and do it utilities, surround our portfolio and the people around us with super clever people that can add value, right? Come on, this is how we got to do things. You got to think better. Like we've got to do better to drive these outcomes. But this is going to be a very important milestone for the financial industry, and I think we're going to be alongside you, Alan, to lead the charge. So I think that's so good.
No, thank you. Controversially, this is the internet moment for financial services. This is, rather than democratizing information, we now democratize assets and access and capital. I think that's going to be a big move for everybody. Think about some of the gates that prevent us from participating in different assets or global distribution. Like this changes how that works.
ESV CLP fund structures or VCLP structures are obviously still very relevant now with some of the new budget changes and all of that type of stuff. So this I think greatly improves our optionality in relation to that, right? Because therefore, they are currently still exempt from capital gains.
If we're going to lunge in there, controversially, that particular, obviously the tax treatment or the capital gains treatment you get through that fund, zero, and an upfront write-off is very favourable in the new conditions, right?
Yes.
So it actually means where people are complaining about investing in startups, it actually means it's more advantageous to invest through VCs into startups.
That's right.
Which is probably actually not a bad structural outcome for everybody. But same thing, I don't have the optionality to go deep on one or not. But if there's nothing stopping you programming up the rights of the fund to allow people to go heavier or less inside. You could kind of divide up the allocation of the fund and let people go deeper or not, heavier or not in the fund, right? So you could still use the same structure and let people do things differently.
Absolutely.
And if you've got the optionality of that liquidity on the top, then all of a sudden this becomes a highly desirable way to invest in early stage businesses in Australia, certainly.
It is a really pivotal moment from a financial services perspective, and especially for venture funds or private investment anywhere. So I think the secondary market that you started speaking about earlier, we've definitely seen a rise of secondaries in bigger markets like the US. But I mean, I don't think I've ever seen a founder's pitch deck that when they get to the liquidity or exit slide, they've ever kind of posed the concept of secondaries to form part of that, either to solve an old cap table or to provide liquidity to investors.
Jason and I have this regularly, right? One of the big challenges with founders that have been in, successful founders that have been in and on a journey, they're still renting their house. Yeah. Mm-hmm. They've still got kids' private school fees to pay. So, we actually always struggle with, well, we don't want them not to have skin in the game, but actually they'd be a better founder and more focused if we could just relieve some of the personal pressures. And so sometimes, we've certainly done it a couple of times where
Definitely.
we've tried to provide some liquidity for the founder to get a better outcome. So yes, there's cleaning up cap tables, but liquidity, is really around matching people's kind of life arc with their investment timeframes, right? So that optionality is super important.
Right? And so important to them, yeah.
It's a great kind of win-win because we've talked a lot about what it could mean for investors coming into this space and the value that provides to founders. But if we can make a wholly more sustainable investment ecosystem for innovation and venture and other people out of Australia, because we have amazing founders, we have amazing businesses. It does cost money in some cases to build and scale those companies. And I think in these last years, a number of people have missed those opportunities or found themselves in a difficult position as a founder that this change and the rise of tokenisation could help solve.
As I said, if we look at the non-regulated ICO market, that demonstrated it was possible to grow. And in fact, I'll confess, most of Redbelly's investment has not come from onshore, right? So people that have understood the vision, understand what we're doing, understood the novelty in the technology, that has been generally a global capital market for us.
Part of that is because super funds are not typically writing checks into this space, right? I think this is providing liquidity may change some of that.
I mean, super funds have got a really structural role to play, right? They have long time horizons with that money, so they are the patient capital. They should be the liquidity providers.
Well, it's interesting because internationally, if you go to the US or you go to Asia, or whatever, like that, the super funds are investing in this category. Mm-hmm. So it's interesting. I don't know why or what we need to do in Australia in order to motivate them to be thinking broader about that. I know that's a discussion and a challenge.
Yeah, I'm not really clear on why they aren't allocating, because they are allocating to venture, just not as heavily to Australian venture. I mean, that's an interesting problem.
That's right. Yeah, that's right.
So, I mean, we're a couple of months in since the announcement of these changes and this becoming law. Mm-hmm. Where does this go now, in your opinion? What does the next 12 months look like?
So actually, there's a 12-month implementation window. So technically, we're still doing more of this. Working with the regulator. So the laws have been now, but now it's a case of consulting with the regulator to get everyone comfortable about what that looks like. We are working primarily the first movers, and sadly, maybe this is an Australian problem as well. I think we're the world's fastest second movers sometimes, and so we're really mimicking what's had product market fit and success offshore. So I think the wave you'll see in the first wave will be kind of money market funds, the same way BlackRock and others did that offshore. So that's certainly where we're moving. So we'll start doing money market funds. I think this will make the banks wake up. I'm going to controversially say this on your podcast.
Yeah.
The banks don't have a need to move, right? They've got a nice incumbency and they get to enjoy this deposit base where they pay very little, if not zero, for the deposit that they get to lever out. starting to make money market funds more available and different payment methods available. Why would I sit in 0% when I can sit in 5% return on my passive money? And if I can get in and out of that more easily than I can today, i.e. going through the ASX to buy a money market fund at great cost, I think there's a real risk that people start going, hang on, I want to sit in a AAA rated savings instrument that gives me a better yield all the time. And that's before we layer on, as we said before, AI saying, we're seeing this in the banking apps now, right? What bills are coming, what money's due or not due. Once AI starts managing my liquidity for me, like put that there, you need it for next week, put that there, you don't, that's long time, that's the holiday. And you've kind of got your own little personal banker money manager. Yeah. How I access these products, that starts to make the lazy capital that sits on the bank balance sheets really start to come under threat. And I think that's where they now they'll be forced to innovate from that position, is my view.
Everyone will be in the know.
Yeah, well, that's right. I mean, that's what I always say. Yes, we're democratizing access with tokenization, but Claude and others are democratizing financial literacy, because that's the other big issue, right? What's this product? How does it work? Is it the right fit for me? Now, obviously, that wouldn't be giving financial advice, but if, as a self-directed investor and or wherever this goes, you've got the intersection of democratizing financial literacy and financial access that's going to really accelerate that disruption.
I call him my friend, Claude.
I didn't know if we're allowed to talk to Claude specifically. Like Claude's becoming the Google, right? It's becoming the category now. I'm getting concerned.
Next level.
And so, I mean, Alan, you've had a venture fund now for a number of years.
Yeah.
What would you do, or what are you doing differently now that these changes have happened and we're just in the world that we're in?
We're not rushing or panicking to do anything right now. We're not in an early stage venture partnership model. We're actually in a trust model, which is even worse right now.
Oh my God.
So we'll have to work out what's the right model going forward for us to hold and manage the investments and structures in. We're just going to wait and see how that takes shape. I think no one's really talking about the trust thing right now. They're still focused on capital gains and others. I think that'll be what it'll be. But I do think that we do have that vehicle, or that's going to make a lot more sense, certainly for us to move to a structure that looks like that. But we will probably, we as a fund generally have been moving to later stage, which I'm a bit hesitant about, because I really think that the early seed stage is underdone in the country. I think a lack of capital at that earlier stage is what makes it harder to invest in that earlier stage. So unless we have a concerted effort to, you think about the US, what's a seed round in the US compared to a seed round in Australia? What can you do with $5? Can you come back when you've got product market fit? Like, it's near impossible. Now, at the same time, we've got Claude vibe coding, a rapid prototype. So, who knows if they start to, I think that can only make Australia, more competitive, because I think we do have, I constantly see we're punching above our weight class because we have more unicorns and against capital deployed. I'm like, that's not something to brag about. We need to be deploying more capital and taking more risk to find more things, not the things that survive and thrive rise to the top, which is still a true statement. I think
all the money's going to the top 40%, right?
Right. And again, that we all make plenty of money from here to there. We're still not really getting things out of the ground. And at the same time, wages are up. So actually, if you want to get two people to pay a mortgage in Sydney or have kids, they can't do a startup anymore. I was lucky enough, I did my first startup. I was living at mum and dad's, right? So rent was pretty good.
Me too.
But if you didn't do that at that point, you could never get started.
1990.
I'm not. I was doing it in 1990. So I think we can't encourage that risk taking. We can't encourage that if we don't resource it appropriately. And because expecting the unicorn founder to have all the skills and attributes to be the domain expert and the scaling expert and the selling expert and the tech expert, like Claude's going to give us some tools, but we need to be able to resource these things properly if we're serious about it. And we need to go earlier with some conviction. And as you said, all that super money needs to be taking, the right level of allocation needs to be allocated down here.
It's the shift to the right, Alan, right? Like you've heard me refer to that. Is that investors have an expectation for more validation, right? And I think Alan has called me out a few times when you say, hey, Jay, we're moving, the new fund is our later stage one. You're moving that way, you're shifting to the right, and you're pitching me this early stage stuff, right? This is the quest, right? There's work to be done.
It's like, as we go through now, like we're in this moment that I think for founders, changes like this do provide some hope and a pathway that there will be just more distribution of capital towards that early stage venture. Because as you say, it is really important but Utiliti also going a direction where we're definitely not investing as early as what we would have in the past. But equally, we do need that sector to thrive. We do businesses to go through the phases to get to us and be ready and to internationalize, and changes like this can be very, very helpful for founders that are sitting in mum and dad's, or sitting there thinking, is now the time that I'm going to take this big leap on what could be the next Canva safety culture, a tool in AI that could build a real value to the Australian economy.
I totally agree. I mean, what do they say? Unfortunately, was it friends, family, and fools do that kind of early stuff? Like that gets us somewhere, but we do need to make sure that really early stuff gets some conviction.
And I think to the founders out there, I mean, that friends and family style rounds are longer now than what they were. Back in 2020, it was a lot easier to source the funding. So I think these are all things that need to be brought to bear to try and set people up for success.
So Alan, one thing we like to do on Rule of 40 is a fast three. So I've got a couple of questions for you. First question, what's one piece of advice in this space you think has aged poorly?
Swing at a big exit. I think everyone's been hanging, they think about the build to an exit point. I think what we're now going to see is how we think about liquidity and the ability to fund our lifestyles differently, and what and when can we realise some of that value for ourselves, rather than just waiting, these overnight successes that are 10 years old to kind of realise liquidity. So I think...
Don't tell Marissa.
you're hold to zero sort of a guy though, right? So yeah, I think that's one. We've got to change the way we think about liquidity. I think the path of Series A, Series B, Series C, IPO is different now.
Yeah, more exit options along the way, right? That liquidity, it will change the world. It'll change, I think, investors' parameters. If they don't have to wait for years in order to get the optionality to exit at a premium when your assets are doing well. We've got so many of those. So many.
Tell us one piece of advice that stood the test of time. What's good advice?
I've got the flip side, the good advice. I still think the one that I think people aren't wary of is the old, if you're not paying for the product, you are the product. I still think that we don't think enough about the opportunities that exist to commercialise in an adjacency. So you can do something, you can provide a service, and then you can commercialise separately. So I think while that's seen as bad advice, I think that's really a creative way sometimes of thinking about your monetisation strategy. So I still get people to think about that.
I think it's, trying to get to product market fit is sometimes challenging, right? We kind of refer to that as, can we just have some real paying clients that are paying real money for a product and or service? You really try and validate something real, yeah? Sometimes founders are in the illusion of product market fit.
I always struggle with this, right? Like, I'm a conviction guy and I'm a conviction better, and it keeps blowing up in my face. But I still like to back people. Sometimes it's timing. Sometimes there's other things that do or don't, serendipitously go for you, and sometimes they don't. But I do think people need to have conviction in whatever the change they want to see or whatever the product or service is. That's not blind faith of the market's telling you you're wrong. Like, definitely set up a pragmatic approach to that. But sometimes, one of our core values is kind of find a way. So rather than just, we had the whole fail fast thing. I don't think about failing fast. I think about pivoting quickly, right?
Yes.
And I think that's important for founders to be able to, lean in on that sort of thing. Think about, well, why didn't it work, rather and accept it and move quickly, but continue. Don't give up on it on the first crack.
And when we've talked about some really interesting topics today around the tokenization of real world assets. And so if someone was curious about, going on a journey and learning more about this space, where would you direct them to start? What was the first, thing that they should go and look for if they want to better understand the concepts we've discussed today?
The answer is, like venture investing, buy something. And then work out what you can do with it. And I think for the moment, and this is going to be controversial because I'm not saying you should buy crypto as a speculative investment, but right now I think sticking into one of the majors and then doing something with it in DeFi. So what I mean by that is go and buy an Ethereum or a Bitcoin, and then go and put it in one of these lending and borrowing protocols, put it in a secondary liquidity, become a liquidity provider just familiarize yourself with what this new infrastructure could look like and what those trades could look like. But just owning something and how do I hold it and how do I secure it, and there's a bunch of complexity there that I think is, but just doing it at the right scale is helpful. And I'm not talking about as an investment. I'm talking about as just to learn how it works, because it's actually relatively complicated. Yeah.
Alan, thank you so much. This has been a really, really insightful conversation and great to capture your knowledge at what is a really pivotal time. And as we said, I think before the show, been overshadowed by other budgetary announcements that we've missed what is potentially the internet for financial services.
Yeah, and Australia's a first mover here. The Clarity Act hasn't passed in the US, so it turns out that we've Stephen Bradbury'd it through to the front of the queue.
Come on.
Yeah, go Australia. And so I think that is a big opportunity that we need to be now thinking about. And we have suffered quite a brain drain in the space due to previous regulatory settings, and I think this is now a real opportunity for innovators in the space to get serious about what they could do here.
I can smell liquidity.
Well,
I can smell it.
I was
smell
going
like?
to say, if Stephen Bradbury's listening to this podcast,
he does.
And he's
I heard
looking
he's a
for
listener.
a new
Steve,
opportunity
come
to
on.
promote.
Come on, Steve. We're helping you out here, bud.
We can get through. So look, that's all we've got time for today on Rule of 40. Thank you so much to our listeners. If you've enjoyed this episode and you'd like to learn more, please follow us on YouTube, LinkedIn, and Spotify. Alan, thank you so much for joining
Thanks so
Rule of
much,
40.
mate.
Thanks for having me, guys.
So
Always
good.
a pleasure.
Cool. Thank you, everyone. Bye for now.
Bye.